The three main financial statements that you'll see are the balance sheet, the profit and loss, or sometimes called income statement, and the cash flow statement. The balance sheet is a snapshot in time of the overall health of your business. It has three main components: the assets, liabilities, and ownership or equity part of your business. So the assets are usually broken down in order of liquidity. So your bank account is going to be the first thing that you see, because you can literally just go to the bank and pull out money. The next things are inventory items that you could quickly sell, going down into accounts receivable, and then into more long-term items like your tools and equipment that are higher dollar items that you would only plan on purchasing once every couple of years, down into the purchase of your physical building, the shop where your shop is located. And if you had to purchase land going along with that, that would be also listed as one of your assets. The liability section of the balance sheet, similar to the assets, is ordered by short-term versus long-term. So your short-term assets would be things like your sales tax or payroll tax payable that will be due in the next month or at the next quarter, whatever your filing requirement is, down into some of your long-term liabilities like notes payable or loans outstanding that you had from the purchase of your business, or if you had to get loans in order to in the startup phase for working capital. So those are listed in the long-term portion of the liabilities. And then flowing into ownership, this is what has been invested in the business. One of the most important things is making sure that your accounting statement, your financial statements are keeping up to date. Sometimes this can get into kind of the bogged down administrative time, but making sure that, for example, your inventory count is up to date. So whenever you do look at your balance sheet, which again is a snapshot in time, if you're thinking of the balance sheet versus the profit and loss statement, the balance sheet would be a picture, and the profit and loss or cash flow statement would be like a movie. The balance sheet, you could pick whatever point in history and say, okay, last quarter, where was I as far as my cash balances and my assets that have been purchased versus my liabilities? And how is that compared to at the end of this quarter? Did our cash balance increase? Do we have, which would lead you into looking at the profit and loss statement to see why that happened, more sales, less expenses, etc. So using that as a snapshot so you can see where your business stood at one point in time. Outsiders that may be interested in seeing your balance sheet would be potential investors or lenders. If you're looking at getting an additional loan for working capital or purchase of large assets, they will more than likely ask to see your financial statement, which would include your balance sheet in the process of getting a loan.
Thanks for watching. Please do not forget to give this video a thumbs up and to share it with the rest of your team. Also, please subscribe to our YouTube channel if you would like to see more helpful videos for auto repair shops. Have a wonderful day.